Welcome to the Industry Experts panel at PortfolioWealthGlobal.com. My name is Michelle Holliday. Today, we are honored to be welcoming back to the show Mr. Andrew Maguire of Kinesis Money. Andrew is a 40-year veteran of the precious metals market. He is an expert trader who has served as advisor for many international hedge fund managers and bullion banks. Andrew is a whistleblower who publicly and notoriously blew the whistle back in 2009 to the United States regulators over the international fraud and manipulation of gold and silver prices. Andrew is our resident real-life James Bond because of his incredible life story and what he had the integrity, the strength, and the bravery to do within a massive trillion-dollar market. He is also one of the world's top experts in trading metals, and we are privileged to have him as a good friend of the show. Andrew, welcome back. How are you today?
Hey, Michelle, thank you so much. And you're very kind, but I'm so happy to be on your show. You do a lot of good work, and you know what? And you're really getting that message out there on a whole range of things. So really happy to be with you.
Oh, likewise. We are thrilled to have you here. This is going to be an incredible show. You are the perfect guest at the perfect moment in time because of what just happened. Now, Andrew, we just had Alistair McLeod on a couple of weeks ago, and he was very specific about watching the end of March as the close of the quarter in terms of precious metals future contracts. So as March ended and April rolled in to begin the next new quarter, break this down for us. What should have happened compared to what actually happened, and what does this mean?
Yeah, great. No, just to add, I personally know and respect Alistair. He recently joined me on a Kinesis Live from the Vault episode. Alistair really, he has an absolute wealth of experience in the financial industry. And apart from him being an incisive thinker, which is rare, so it really, when it comes to the economics of the financial history, he is second to none. Now, he was almost certainly looking at the growing dislocation between the COMEX-determined non-delivery paper market and the real physical market, where conversely, we see good demand. Well, he was obviously looking at the difference. And likely what he was referring to was, as we commenced March trading, now these hypothecated COMEX positions had grown to historically high levels, and they looked really vulnerable for a short squeeze. In fact, what we evidenced was the 10 times larger loco London spot gold delivery markets trading at this, and get this, at a $6 premium per ounce to the COMEX-driven March price. Now, futures are not supposed to diverge away from the cash market to that degree. So what these backwardations, and if looking from a wholesale perspective, these backwardations were absolutely unprecedented. And what it telegraphed was that the COMEX-driven prices were unsustainably way too low. Now, any futures market discount exceeding $2, which is the cost to take COMEX delivery, about 50 cents, and ship and deliver COMEX gold to a physically starved market in Switzerland and Europe, what that does, anything about $2 or more triggers COMEX outflows, which is not what the casino wants to see. So, so immediately after the Bank of International Settlements squared off close to $1 trillion of over-the-counter derivative positions, and that was on the last trading day of March. What we did was we evidenced insiders scrambling to short cover from the gold was in the 1680s at that point. And really, that was exactly 1 month ago today. So silver also was trading about $2 lower about a month ago from exactly a month ago from now. So Michelle, what we're saying is there's a massive shortage of gold and silver bullion for immediate physical delivery. And that's the key here, immediate delivery. And what is available is commanding actually very large refiner premiums. Now, there's little to be gained to invite a deeper sell-off than March. And this will simply increase spot gold related physical demand. And in turn, what it'll do is push the front month gold futures deeper into backwardation. And what that's going to do is further risk another exchange for physical blow up, hundreds of dollars higher than we experienced a year ago in March 2020. And this was when we saw a fracturing of the paper market. And if you remember, if we look back to March 23rd, a year ago, we suddenly saw overnight $100 premiums in gold, forcing central banks to step in quickly and bail out the too big to fail taxpayer-funded bullion banks caught on the naked side of a short trade. And directly after this exchange for physical conduit, so in other words, the EFP is a conduit between the COMEX and the physical delivery markets in London. That's what blew up, because between March and August, after it blew up, gold rose $600, and in the same period, silver rose a full $18. And now the reason that I bring this up is because it was due to a shortage of physical gold that fractured this EFP conduit. And currently, we are evidencing, as of last Thursday and continued now, Swiss refineries completely sold out all the way into August. That's for any size at all. So, and even the kilo bars that are in small size are commanding big premiums. And so what we're saying is any size, from here on, any size demand will actually threaten this EFP blow up again. Now, especially as we saw the last time, a complete exit of the second tier banks, a lot of them European banks who've exited because of high counterparty risk, the profitable third-party custody business, and they have not returned to use the COMEX as a hedging tool. The COMEX lost a lot of credibility through that because it's simply, people realized the paper price could not be relied upon at the COMEX to actually hedge your positions in the over-the-counter market, which have been for the last 50 years been the case. Now, this is a catch-22 predicament, and the House has got itself into it. And it's the first time, as I say, in about 50 years that the COMEX control of the COMEX price as a price setting mechanism has come actually under attack. So in other words, put it into backwardation, make COMEX prices cheaper than the physical delivery price. What's going to happen? People are going to come after it, aren't they? And that's exactly what was happening. So really, just to give a guide, $2 is about the trigger point. We saw it. And physical traders targeting the COMEX registered inventories are not the only risk to the House. Now, we're certain that actually central banks and sovereigns are busy bolstering their balance sheets ahead of Basel III gold revaluation.
Hey, this is a quick reminder from your crew here at the Prosperity News Network. Now is the time to protect yourself with precious metals. By using our discount code, Michelle Holiday Sent Me, our audience and our website subscribers are receiving the best prices in the country on silver and gold from Andy Shechtman, the owner over at milesfranklin.com. We all know that our fiat currency is burning down. Everyone needs to own precious metals. Miles Franklin Ltd. is one of the most trusted precious metals dealers in North America. The website, milesfranklin.com. The discount code, Michelle Holiday Sent Me. Start stacking now because we have no idea when everything could change overnight. Now, back to our show.
Well, this takes me straight into the next question, which is Basel III, which of course is a very important banking regulation that is going to, scheduled anyway, to take place in the next 90 days. Now, is that a hard set that it has to do it, number one? And number two, please break this down for us, Andrew. What is Basel III?
Right, that's actually a great question, and this is the most important subject right now. This is a historic and a bullish event for gold. And it's ultimately going to lead into a physically driven gold price revaluation. And this will significantly influence the global financial system too. And so just to provide a little color, I mean, that's a big statement. So add a little color to that. And so really, if we step back, following the 2008 financial crisis, Basel III rules were drawn up back then to eliminate future interbank counterparty risk. Really, we couldn't have another daisy chain collapse like that without the entire banking system collapsing. And so these rules quickly segue into Basel IV, which is actually extremely onerous for the financial system, which will be implemented by 2023. So let's concentrate on what we're looking at now is Basel III. I guess more immediately, what people want to know is, okay, it all sounds great, but how's this going to affect gold? Is it going to be good or bad for gold is the question, of course. That's what everyone says to me. So to answer the question, under Basel III, unallocated gold, which currently actually makes up the bulk of all daily gold trading volumes, represents really nothing more than a really high counterparty risk paper gold credit transaction, one that is shuffled around inside a daisy chain of LBMA bullion banks who net out this working stock, as they call it, on the books at the end of each day with almost no physical gold ever changing any hands. But as of June 28th, which is to answer the question when, it is these gold credit transactions that will suddenly receive an 85% haircut, while on the other hand, real allocated physical gold will actually receive a 0% risk weight that will apply to gold bullion held in a bank or held in another bank on a purely allocated basis. So what we're saying is, obviously there's more, it's more complicated than that, but essentially.
That's already complicated enough, trust me. Go on, we'll have you talk about this the entire hour, go on.
But, obviously I think where people get confused, there's some currency risk attached to that. So suddenly physical gold sitting on your balance, sitting in your bank is now, is the equivalent of cash. It never was that. It was always had a haircut. I think the onerous part is that unallocated gold gets an enormous haircut. It cannot really be used anymore. So what I'm saying is to eliminate the currency risk, obviously we see the currencies move up and down all the time. So to eliminate the currency risk and to make sure there's a 0% weighting to it, cash weighting is then you need to hedge that position. So that's what we're saying. So any hedged allocated gold is cash. Now, really, it has to be borne in mind that gold and silver are not just commodities. Now, as they trade as one leg of a currency cross, so that would be just like you would be familiar with dollar yen or euro dollar or whatever it might be. You've got your long one side, you're short the other. So long foreign exchange gold, and that trades as XAU in the foreign exchange markets. What you're doing essentially, if you're buying a gold position, you're shorting the dollar in equal amounts, and vice versa. If you're long the dollar, you're short gold, etc. That's the same with silver, which trades as XAG against the global currencies. Now, a lot of people who have been siloed into the COMEX casino, and the fact is I had to get rid of all my US clients in about 2013, simply or be blacklisted, was simply because what they wanted to do was silo all US traders into the COMEX casino and not allow them to trade in the much larger, 10 times larger over-the-counter markets, which is ludicrous. But also what it shows how they're trying to contain, it's a desperation measure to contain the price of gold. And I think also when you add in that there was rules came in within a year that said, oh, by the way, I can freeze the COMEX market for 5 minutes. Oh, but by the way, us, the traders, I mean, in other words, I'm talking about now, if I'm JP Morgan, if I'm UBS, if I'm any one of the market makers, oh, sorry, yeah, you're frozen. I'm not frozen in the over-the-counter markets. I'm not banned from trading those. So if there's a market halt, for example, say, a market halt would usually not be in the case of a down spike. It would be in the case of an up spike. So if that parameter was called in and they want to settle the market down, obviously at that point there, what that does is you're frozen out. If you're a US trader, you're frozen out. You're siloed into this casino. You can't see outside it. Well, whereas the market making banks can hop into the over-the-counter market, take a long position, and be on the right side of the trade. When the market opens, do you think there's going to be any sell orders? No. So, you know, it's just illustrating little snippets of information that show what a rigged game this is. Or
there's so many nuances to this, Andrew. So many tiny little games that they play that have massive effects. I didn't realize how the US, I mean, we could be really seeing that as, you know, prejudice against the United States, but really what it is if we were in there constantly playing and they didn't control us, they wouldn't be able to control the market at all. You know, Andrew, nutshell what Basel III is. Just nutshell it in like 3 sentences. The challenge of the day.
Well, Michelle, I think basically, look, in other words, we see 8,000 tons. So this is a nutshell of it all. Every single day in London, now this will blow your mind, it should blow your mind, we see 8,000 tons of gold traded, cleared through the LPMCL every single day, right? Now, only 3 to 5 tons of physical gold ever gets actually delivered. So you can imagine, if you're going to put, and this 8,000 tons is unallocated gold. So you can imagine what will happen is you put an 85% haircut on those positions. Well, they become way too expensive to trade. And really what you're doing is essentially removing a lot of this 8,000 tons of paper, of absolute air out of the market, draining that liquidity as people will now be in a better position to have a physical market. It's actually, the physical market is actually going to become stronger than the paper market. So essentially, because even insiders, and we're talking about the Bank of International Settlements, for example, they would have, they have something like about 550 tons of leased gold in the system right now. However, that leased gold is unallocated gold. Not a single ounce has left their site account for at least 3 to 5 years. We know that because in the wholesale market, when this supposed leased gold hits the market, it never appears anywhere to buy. So we absolutely know, and we're absolutely certain that with this 550 odd tons that as of March was sitting on their books as leased gold, was purely unallocated gold. So what we're saying is at some point, this is no longer going to be a viable proposition.
Now, explain what unallocated gold is, just for anyone not familiar with the term.
Yeah, unallocated gold is basically gold. It's paper gold. It's gold that trades in the fractional reserve ecosystem. So, for example, every fiat currency is basically, if you deposit your money into the bank, it isn't that money that gets lent out. It is leveraged multiple times. It is used many times to finance mortgages, and it's used as, in fact, that was one of the issues with the Lehman collapse, was because it had been hypothecated, rehypothecated.
It's air. You had, that's the perfect term you said about a minute ago. It's air. It's so paper, unallocated gold is paper gold that they trade, and they trade in massive amounts, and supposedly it represents physical gold, which is not there, right?
Correct.
Simple.
It's 100 to 1, Michelle. So, and even the industry apologists have admitted that, yeah, okay, so there's 100 ounces of gold traded every day for every ounce that's actually in a vault. So if 100 people turn up for their ounce of gold, only one of them is going to get it.
That's right. You better be big.
So really, just I think one of the key things here that is important about Basel III This window is fast closing now. Obviously, we're talking about 70 odd days until this window closes. So, and that gives very little time for the banks to unwind these very large unallocated gold positions. I mean, there is literally billions of dollars worth of them. And because after this date, it become far too expensive for them to engage in gold lending or hypothecation. So really what we're saying is, in anticipation for this new regulation, banks do not want to be short gold. So we're going to see a rapid change in the stance of how banks now view gold. So it's a really, really dynamic event.
Yeah. Yeah, it's so important. It's like they know they can't do it anymore, basically. The scam, the air gold, the paper gold, the manipulation can't happen anymore under Basel III. So now what we're seeing is just massive activity. And that's why Alistair was talking about watch that quarter, watch what happens then, because now the future contracts are basically the pivotal point of this. And that's what he was talking about. And I think they're up for June. They had to explain how that works for us.
Yeah, so what happens is at the end of each futures contract, I mean, really what we're talking about ordinarily, a COMEX contract is never delivered, physically delivered. It is a bunch of paper warrants saying I have a share in, I have a claim to this gold that's sitting in registered or in registered inventories of the COMEX, and that I'm going to try and seek to gain or lose from the rise and fall of it. So, but no one ever delivers this. I mean, it's the issue that I think was coming to mind was, hey, you put that too far into backwardation, which we just explained, that you put the future price below the cash price, below what you really have to pay, then literally you are going to then come to the COMEX and say, give it to me. Just give it to me. In fact, I can't get it anywhere else. You seem to have all this bullion floating around that's never delivered. I'll take it. Thank you very much. And so I think that, see, one of the kickbacks that people say, oh, come on, Andrew, look, do you really think that the central banks are ever going to like gold? Well, yeah, I'm telling you, this is such a tectonic shift. So the view is that officials headed by the Bank of International Settlements, that their gold desk in Basel, Switzerland, Benoit Gilson sitting there at 6 a.m. every morning, and we watch his footprints. Look, the word is, look, they hate gold and they want to continue to suppress gold ad infinitum. In reality, Basel III changes this as to defending US dollar hegemony as a far more important status than just defending gold. So I think getting on the right side of gold is what they want to do.
Oh, how interesting. How is it going to affect the US dollar, Andrew?
Well, it certainly will, because basically, I mean, if you think about it, it leads into a bigger story, basically, which is basically, look, you've got China and Russia now moving in, as well as all the BRICS countries, all moving in to buy physical gold. They're not part of the club. They're not part of that club where the Bank of International Settlements is looking after the gold of all central banks and is managing it for them by leasing out unallocated gold, et cetera, et cetera. So essentially, China's thrown down the gauntlet recently and said, hey, I tell you what, we were capping the amount of gold that can be brought into China. Think we'll actually raise that cap now. That was a shot across the bow of the US financial system. That was a shot across the bow of Biden's win-lose global sort of economic view, where you have to have a winner and a loser, when really we should be looking for a win-win situation. So really they're just saying, be careful, because we're a big buyer. And hey, and this is the I think the final sort of bottom line of that, is China's probably got 25,000 tons of gold. The US has 8,300 in round numbers, although that's probably rehypothecated, because if you remember when Germany back in April of 2013 said they wanted just 300 tons of this back, it was going to take them 7 years to give it them back. Well, so, you know, we all get a bit concerned, and that's why many central banks have decided to repatriate their gold. But essentially, if China came out and used that threat and actually disclosed they had 25,000 tons of gold, that is going to depreciate the US dollar so rapidly because basically suddenly you're going to look at a currency that is backed by so much gold versus a currency that is backed by very little gold. And to me, that would be a sense, I think there's going to be part of this Basel III protocol is to say, look, we know they're going to do it at some point. Maybe we should revalue gold before that happens. And so I think you're going to see the central banks moving on the long side of gold. Why wouldn't they? Because if you can now raise the value of gold, and if you can actually, then you can divide your debt and put your debt behind that, you can actually probably raise 6, 7, 8 trillion. You could also, you know, back your currency with that. So I think it's an interesting situation. Russia has already clearly demonstrated it's selling its dollars to actually invest in gold. So it kind of definitely got U.S. hegemony is definitely under attack.
Wow. Wow. You know, what comes to mind is China has so many more people than the United States, but we're not comparing numbers of people to people. We're not comparing numbers of dollars to yuan, basically, right? And we've been printing our dollars in a massive way, which means there's, you know, huge amount of dollars out there in comparison to not so much gold. So when China says we've got 3 times more gold than you do, that would equate to our currency is 3 times more valuable, at least, to yours. Am I correct?
Well, exactly. So, in other words, you know, fiat. What are currencies backed by? I mean, really, this is it. Since 1971, when gold was depegged from the dollar, Nixon depegged it, and what happened to the actual purchasing power of the dollar? It's gone down from to literally 1 cent in relative value. And so really, I think that's why the COMEX was brought into being 50 years ago to say, hey, look, you know, they're just taking all our gold at $40. You know, it's like, hey, we're going to stop that. What we'll do is create this fake marketplace, inject massive liquidity. Let's sign up these people out who think they can get gold. And we'll add so much paper gold into the system that we can actually control the price. What we're saying here is that finally this game has shifted, and what's happened is the likes of China, the BRICS countries, other central banks are saying what we were doing before 1971 was exchanging our dollars for gold. Now we're doing the same because we know that gold is going to be, and they have been accruing it very stealthily, because one of these days we're going to tell you, turn around and say, we've got the gold. What have you got? And do you know what, Michelle? What blows me away is the average American citizen is holding maybe an ounce of gold. I mean, we're not talking about you or I. We're not talking about and people that are well educated into physical metals and real assets. But the average American probably owns an ounce of gold in jewelry.
Oh, right, in jewelry. Mm-hmm.
Yeah, that's about it. And so, but then if you suddenly cast your mind outside of that continent, and you go as far as India, and you've got this little rural farmer cycling down this dusty path. He's got 5 kilos or more of gold. I mean, because they value it so much. He goes to the market with a gold coin to exchange that gold coin for goods. And they view gold differently to us. And I suddenly think, you know, when there's a revaluation, I mean, this is a tectonic shift, because the average Indian farmer is going to be extremely wealthy versus the average American. I mean, they're going to be coming out and buying all your houses up. If they, yes. I mean, they probably don't want them, but I mean, anyway. But yeah, I mean, think in those terms.
You know, and the thing about it is we've been printing fiat currency like crazy. No one has said a word. It's like, oh, we can't stop them. Yes, we can. Yes, we can. They are not even, you know, part of our government. They're just a private entity. We all know this now. And what they've been doing, we've got to take control of this, because when you can, when you continue to do this and continue to allow it, oh, nothing's affecting us now, nothing's affecting us now. American people, even the ones that know about this, are so naive as to believe that what we do affects us and we better watch out. We don't take into consideration what the rest of the world is doing and what the rest of the world is watching us do and what they are coordinating their actions to do to put themselves in a massively high scale when we massively fall overnight in comparison to the rest of the world. And since we are now global, it has a huge effect. And that's what people don't take into account. They're like, oh, well, it's printing. We see a little bit of inflation in comparison to our dollars. They're so micro focused. They have blinders on looking at the United States and how it affects us when they don't realize what's going on in the rest of the world.
Yeah.
And we literally could become a third world nation overnight. And I know that I'm not supposed to say that. I know it's politically incorrect. But when you look at third world nations now who have nothing because their money doesn't buy anything, you got to look at the future ramifications of what we're doing. Am I right on this, or am I just being panicked?
No, I think you're right. I mean, let's face it. I mean, this is a polar shift in, look, the banking system is broken. Look, Michelle, when we think about it, and we were talking about a world where negative interest rates is accepted. Even the Bank of International Settlements is saying, oh, come on, this is the way it's going to be. I mean, to be honest, what does that do? How does that value every single tangible object that forest, lands, infrastructure, gold, silver, doesn't matter what it is, it has to be worth more in depreciating dollars. It has to be over time. And you have to think about, it's not just as it was. It's not just, how have we got here and what has changed? And I think so much has changed. So you can't print that kind of debt. You cannot just wash that debt away. Something has to happen. What has always been of concern is usually start a war. I mean, when central banks get into trouble, that's usually what they do, isn't it? But in this case, that's a little too dangerous. And I think that's why I think it's so important. It brings me right back to gold. The only real solution that I can see is to just revalue the damn thing and be done with it and get on board, because you're going to have to, otherwise you're going to be left as what you just described, a third world nation. And I think it's so important. I think this is what Basel III addresses. And I think that it's that big a deal.
Right. That's why we always talk about everybody needs to own at least a little bit of gold and silver. Just even if it's 3 pieces, because you people, oh, we're just printing it, we don't know what we're doing. They know what they're doing, and they know, and this has been repeating itself throughout history. And we've been trying to sound the alarm for people, and our viewers know it. But stack, stack, stack. Let's switch gears to silver. What did you think of the silver short squeeze that just took place a couple of months ago? And there's a second one that's being talked about. What could that do? What effect could that have? Because I heard that there were a couple of hedge funds that actually fell when that happened. It wasn't well publicized, but this has a massive effect when they can't control silver.
Yeah, this silver short squeeze has actually become a movement. And I think it's important to look at it as that. This is not just a trade. It's not, and it's coming through I mean, literally thousands of potential diamond hands, as they call themselves. And I think this is going to endure. And for it to succeed, though, it's important not to play the leveraged paper game. To be successful, a silver short squeeze has to be conducted in the physical marketplace. Now, industry apologists, and there are plenty of them, the mainstream media and news services, I mean, they all scoff at this. They try and make light of this Wall Street silverback short squeeze, but most of them erroneously liking it. Well, look, they tried it in 1980 with the Hunt brothers. Hey, come on, that is that comparison is farcical, because the Hunt brothers had borrowed silver on margin from the house. And like any casino, facing losses, once the punters hold too many chips, what do? You change the game, and the casino simply called in the debt and crashed the paper price of silver. So, but this is not the case with the short squeeze. It's being driven by fully paid up silver demand coming from literally thousands of Reddit raptors swarming into physical gold and silver. So if we as a wholesaler to go and try and buy 100 tons of silver, we are not going to get that size at once. You'll be blacklisted. What you have to do is you have to be very stealthy, go around. We have 12 trading hubs and vaults around the world. And we have to sit literally, you get what you can, and you literally fill your orders quietly. But when you've got thousands of essentially raptors coming in after a T-Rex, essentially, the COMEX, so what can you do about it? They're just buying silver. They don't care that it is a wholesale price. They just want to buy their silver. And they'll buy it. They realize, well, one day this silver is going to be worth a hell of a lot more. Do you think they care if they're paying a $3, $4 or $5 over for an ounce? They just want that silver. And they're long-term players. So I think that they're not even players. These are investors. I think this onslaught is going to overwhelm this paper game. And every time you say that, well, sometimes they come in and these guys try and sell the market down. All it does is incentivize them. I see it on this. Let's get some more, stack some more. Hey, it's on a discount. It's no different to Walmart having a sale on something. Everyone rushes in and buys it. You can't shake these guys out. And it really heartens me, actually, to see the pride taken by these stackers. I mean, literally, we are all part of the solution. Every one of us that buys physical, you just mentioned it. So in 45 years of precious metals trading and investing, I've never, ever, ever seen such passion behind a trade, because it is a movement, and that's what I love. And so to those doubters that do not understand the power of this physically driven short squeeze, it's barely started, guys. You cannot rinse out these diamond hands.
Andrew, in terms of pricing, which of course is what everyone wants to know, what are your predictions for physical gold and physical silver, and what is your timeline?
Right, and this boils down to how central banks value gold, because they're the guys that are going to determine the price of gold ultimately. They always have. And we touched on how Basel III and IV addresses this major paper physical imbalance. But now let's look at the global central bank's view on gold as we move into these Basel III crosshairs. So basically what it boils down to is that gold's collateralization of US foreign obligations has reached historic lows. And under the covers, this is one of the main objectives that Basel III and IV is forced to address. And we see this as the primary reason gold must be revalued. And the current ratio, and this is the key thing, and this is how to price it, the current ratio of gold to foreign debts outstanding is currently about 6%. Now, this ratio is significantly below the 20 to 40% historical average, which the Bank of International Settlements likely expects this ratio to revert to following the implementation of Basel III rules. And simply restoring the norm, the 20 to 40% ratio of gold to foreign debts outstanding from current levels, easily puts gold at around $6,000 to $12,000 per ounce. But the last time the US dollar was questioned, and it's not being questioned yet, that was in 1980. And you know what happened? The foreign age treasuries of the US government were 140% collateralized by gold. Why? Because the dollar was in question, which is kind of what we were talking about earlier. And at 1980 levels, that would put gold at $43,000 an ounce. Now, look, hey, don't know I haven't gone crazy. And this is I'm just reeling numbers off that how central banks would look at this. Obviously, they're going to avoid the dollar collapsing. But look, I think gold by 2023 will have to be trading around $10,000 per ounce, somewhere between the two. But silver, I mean, that's the other thing, because that's close to our heart. Michelle, I know it's close to your heart. It's close to my heart. Look, silver, how is ludicrous. The normal ratio, the historical ratio, 15, 16 to 1. Currently, 60 to 1, 60 ounces of silver to buy 1 ounce of gold. Now, look, even if we use the same formula, even if we don't adjust that in any way and say it's 60 to 1, that's $100 to $200 per ounce. And if it was 1980 levels, hey, you know, okay, that's $680 an ounce. I'm just giving you the numbers because, but basically, as gold breaks out of this unallocated collar that we've been talking about, silver's going to do the same thing too. And that really puts silver back into the 16 to 1 crosshairs. And hey, that's got to be somewhere between 375 and 750 bucks an ounce. So, hey, that's my numbers.
Wow. Wow. You know, I mentioned at the top of the show, you are a man of such integrity and bravery and what you did. And I want, for anyone that doesn't know your story, I hope you can nutshell it in a short kind of a way. But in 2009, you actually called out a market at that time that was massive. And that's putting your life on the line. But what you did was you went to the US regulators and you told them there was massive manipulation, and then you proved it. Now, this was over 10 years ago and nothing really happened, but nutshell your story for everyone that hasn't heard it, Andrew.
Yeah, basically we saw what was going on, and I think, you know, as much as we've demonstrated, we have over 80 cases where we actually, and in some instances we did it publicly ahead of time and said, by the way, silver's going to be at this price tomorrow, but we did it 80 odd times through lawyers, timestamped, provided to the CFTC, provided to the DOJ, saying, by the way, guys, this is where the price of silver will be and the price of gold will be to the tick tomorrow. Now, that's like knowing which horse is going to win the race, right? So, you know, yes, you could make billions doing that. But on the other side of that trade, the reason I turned as a whistleblower on this, the reason on the other side of that trade, and it really drew me, for when this 2008 smashed from $21 in silver down to $8.50 in silver, that's what really triggered me to do something about it. Because on the other side of that trade, while people are celebrating, these young kids out of university, you know, everything is just wonderful. We've just made so much money. A new Maserati. I mean, God, what am I going to do with the rest of my money? Let's have some $1,000 Cristal bottle of champagne. On the other side of that trade is literally people put out of work, entire communities put out of work. And we have even had evidence of suicides in Bolivia when proud people turn up to work and there's no work, and for generations they've mined silver and the mines are shuttered. There's no social care system. You know, this is the other side of that trade. And so who in their right, we'd have to have no integrity to take advantage of a situation like that. So we blew the whistle on it rather than trying to trade it. Obviously we could have made billions doing it. That's just wrong. I mean, and life's too short for that kind of bullshit. And so basically that's all that happened. We provided the evidence. We even did a presentation to the DOJ. We came out of there and they said, oh my God, what about the economic consequences of this? Because this clearly shot all the way up the line. And this Michael Nowak, who was one of the people that I can name him now, but basically that was obviously, he's been named by the DOJ now, and in fact the whole organization, JP Morgan's been named a criminal enterprise by the DOJ. So we can talk about some of this evidence, but believe me, there's more coming down the pike. And so, you know, really, I think what we were trying to do was really stop this absolute mayhem that was being caused in a market where really it was so unfair and so wrong. And I think that was really just one of the reasons that motivated me to do it.
It's just so beautiful to realize that when there's a winner, when there's a clear winner, when not everybody wins, there are winners, there are losers. And the losers lose, you know, on an equal basis, if not more, than the winners. And it devastated so many people overnight. Like I said, surprises, because they didn't see it coming, but you did. And we salute you. And we're going to be watching your story as that comes out. We're also going to be watching this Basel III. This is huge. As you said, this is the Titanic going down, because this huge paper market is about to change. It's going to be so exciting. We're going to keep you coming back. Now, before you go, I want you to please tell everyone about Kinesis Money. What is it and how does it work?
Well, it's a really exciting project. I mean, basically, we're talking about digital gold here. And I think it's got to be done in the right way. And what Kinesis, and really this also segues in from coming out of the DOJ thinking, well, they're never going to do anything, the economic consequences. So what do we do is I walk straight into that very month. There's no such thing as coincidence. I walk in and meet the very guy that's opening up an electronic physical exchange, Thomas Coughlin, and he's like a brother to me. We literally we literally brought in, or I assisted, and this big team came in to build this allocated bullion exchange, which has global vaults all around the world. And the ultimate goal was to create a digital currency that everyone could use, and without having a global physically set price, not in the paper markets, but by aggregating the price in 12 vaults around the world, you've got a real physical price. This is the price that somebody is really going to sell your gold, their gold and silver into. And so then you've got a real price. Then you can digitize it. And so what Kinesis does is kind of marry up the latest in payment technology with the oldest and greatest store of value to make money what it should be again, which is the greatest store of value and the most efficient means of exchange. So digitizing gold has provided us the key. So really it's all about utilizing trustless blockchain technology, digitizing it, making sure that the gold that is in your account is in your name. It doesn't sit on the balance sheet of anyone else. It's physical. You can take delivery of it. And what we do is we wanted to create this movement, which we have, where so many people have now starting to adopt this currency. And what we do is, because normally you wouldn't use gold. Look, if I've got gold in this hand and I've got a dollar in this hand, I'll spend my dollar and keep my gold. But if I'm incentivized to use that dollar or that gold, and I get a yield for it, and it doesn't cost me anything to store it because I'm I'm sharing in the ecosystem that I am assisting with, then really what we're doing is we're bringing people from all over the globe in to use a currency where it's physical gold, it's physical silver. You can use it as a currency. It doesn't cost you anything to store it, but you own it and you can take delivery anytime. It is just revolutionizing the way people are going to use money in the future.
And I love that you were partners with Tom setting this up, because you have such an extraordinary integrity level, and you proved it by putting your actual life on the line with what you did. And that's the truth. People have been disappeared for much less in our world. And you're just an extraordinary gentleman. This has been an amazing interview. It's always wonderful to have you here. Now, Andrew, please give us your website and how to follow your work.
If you go to kinesis.money, and come and join us. Come and just open up a free account. Doesn't cost you anything. See what the prices are trading, how Bitcoin is priced into gold, how Ethereum is, how we have all these currencies sitting on an exchange. You don't even have to use it to just see what's going on. And then I'm very sure you'd be very tempted to use it once you open it. But anyway, I'm just invite people to go onto the kinesis.money website. Have a look at, there's a bunch of 12 videos, 2-minute videos there showing how everything works, explains everything. So that's what I would really encourage people to do. Come and join us on the journey.
It's extraordinary. And also where to find your videos and also your articles.
Yeah, live from the vault. We do one every 2 weeks. and really just basically keeping everyone abreast of what's going on largely from a wholesale market perspective. It's one thing to look at the paper market. It's nice to balance in but how does that relate to what's really going on, to the footprints we see? Where are the whale footprints? Where are the levels where we think support and resistance are? Those kind of things are really important to people.
Oh yeah. Oh yeah. And they're so interesting too, because they're the truth. And your website is so much fun. Thank you so much. We will definitely have you back once a month, because as this heads towards June, things are changing so quickly. Precious metals is becoming the absolute movie of the century, really. Don't you agree? The excitement here.
I am, you know what, I'm so fired up. And you know what, Michelle, it doesn't matter how many years old I am, I just feel so young again. This is just part of this enormous, we're going to be looking at this in the rearview mirror saying, wow, why didn't we take advantage of this time? And that's what we're trying to get across to people. It's happening, guys.
It's happening right in front of our eyes right now. Andrew, it's been amazing to have you here. Thank you so much for coming on this show today.
Hey, Michelle, look forward to coming back anytime you want.
Absolutely. Mr. Andrew Maguire, precious metals expert, whistleblower, and director at Kinesis.money. For the Industry Experts Panel, I'm Michelle Holliday at PortfolioWealthGlobal.com.